Nobody likes the idea of their mortgage payment going up, and that surprise can definitely be one that costs us big financially. If you have a fixed rate mortgage and you've seen your mortgage payment increase, this means only one thing. That means you escrow your taxes and insurance, and that's where the change happens. So in today's video, we're going to talk about what an escrow account is, how these accounts work, and how to make sure that you're not taken by surprise when those tax bills come out. All right, so let's start with what's an escrow account. So an escrow account is a dedicated account that is in place to pay your taxes and your insurance when those bills become due and payable. This is set up when you close on your properties. When you buy your property or if you refinance, that's when this escrow account is put in place. And when that setup happens, there will be a deposit made into that account to make sure that when those bills come due the next time, there's enough money. So when we talk through that, I think that something a lot of people miss is that there is this requirement for a balance in that account at all times. You must have 2 months worth of taxes and insurance in that account. And this can go up or down as your bills fluctuate. So if your tax bill goes up, then that 2-month cushion has to increase and so on. So when you buy a home, for example, and someone sets up, they have their new escrow account put in place, this means the lender is going to put 2 months worth of taxes plus whatever's due for the remainder of the time frame. And I'll give you an example. Let's say that you buy your property. So in Cook County, let's say you buy your property and you close on that property in December. So this means that you skip over the month of January and your first mortgage payment is due February 1st. Traditionally, that's when tax bills come out and they're due and payable. Well, February 1st, you'll make a payment into your escrow account, but that bill's already due. There's not gonna be enough money to pay that bill for you. Don't worry about it. What happens is when you closed in December, there was a cushion, not only the 2-month cushion, but there would have been 6 months worth of deposit put into that account. This way, that tax bill's covered. So when you're buying a home or you're refinancing, you'll see this escrow deposit to make sure that there's enough money to pay your taxes for you. This is the same with your insurance. So homeowners insurance, when you buy a home, is going to be paid for a year in advance. This means that when you buy your home at closing, you'll pay for that premium for 1 year. It actually feels like you're double paying your insurance because you'll have this monthly installment going into your escrow account. You'll be paying monthly towards your insurance, but you just paid it for a year. Well, when you close on a property, not only do you have to have a 2-month cushion, but generally a lender is going to put 3 months in there. Why? Well, let's talk about that. So the 3-month requirement is based off of the fact that your insurance will be due and that bill will be due in a year, right? And that bill will come up 1 month before your 1-year anniversary. So there's an extra month in there that has to be accounted for. Also, you skip a payment, right? Again, you closed in December, you skip January, you start paying into February. That means when your bill comes due, all of a sudden there's not enough money in there. So your lender is going to, again, ensure that there's enough money to pay that bill when it becomes due and payable right before your 1-year anniversary of buying your home. And therefore, your homeowner's insurance is always paid for a year in advance. Now, so fast forward, you're making your mortgage payments and all of a sudden you get this nasty notice of a mortgage statement and your payment's gone up drastically. Why? What happened? I see this happen a lot, and we've seen this in the last year happen a lot with certain loan service providers. There's some banks out there that were really mismanaging the escrow accounts. But essentially what's happened is that your tax bill went up, right? So let's say your taxes went up, we'll use easy figures, $1,200. Now, realistically, you would say, okay, well, now I owe $100 more a month. Well, keep in mind, the escrow account will always pay that bill whether you have enough money in that account or not. So what happens when your tax bill goes up, that escrow account will disperse, pay that tax bill for you, but now it's drained the account. You no longer have that cushion in there, right? That 2 months is no longer there. In addition to that, you're now short and you have to make sure that you're putting enough money into the account to make sure this doesn't happen again. So what most banks will do then is they'll set up a period where they pay this on your behalf and then they'll want to recover those costs over the next 12 months. Now, this can result in a big increase in your monthly payment because not only are they increasing your payment to recover that money that you'll need that you spent, but they also need to make sure that this doesn't happen again. So you're funding that deposit, making sure that 2 months is in there. You're funding the difference between how much now needs to go into that account to pay the taxes when they become due and payable. And then you're funding the difference in what they already paid on your behalf. So this can add up quickly. Here's a quick tip if you find yourself in that situation and it's unmanageable. You can reach out to your loan servicer and ask them to extend that repayment period. You can ask them for up to 60 months in some cases. Now, it's up to the loan servicer how much time they give you, but if you reach out, let them know that this increase in payment is just a little too much right now, then you can look to get that spread out so that the money you have to pay back is it's not going to sting as much, right? Your payment will not go up as much. Now, as far as insurance goes, it's the same principle, right? If your insurance goes up, then the escrow account is going to pay that bill on your behalf. If it's short, they want their money back. They have to make sure now with the escrow account that there's enough money going in to fund that to pay the next bill, which is now increased. And then on the flip side, you have to pay back the money that you owe. Generally not going to be as big of an amount, but when these two things happen at the same time, your taxes and your insurance can go up. I mean, you can see payments go up all over the place. If you've seen this happen, the number one rule is to reach out to your loan servicer. Ask them for an escrow analysis and ask them to break this down to have a better understanding of how much everything went up. Now, to prepare for that, right? So if you go through and you reach out to your loan servicer, make sure you have your recent tax bill and go back and track the previous 2 years so that you have those on hand for the conversation. You want your insurance and your tax bills handy so that when you talk to them, you have the information available to say, look, this is how much it went up. Based on my math, these are the figures, because you can't trust that the escrow management has been done properly. It will get corrected at some point in time, but that could cost you a lot of money out of your pocket in the meantime. So just have those resources available and you'll be able to have that conversation and talk through a solution. Now, one thing that we have to talk about is the best way to keep this from happening in the first place is to be proactive. Okay, when you buy a home, you have an escrow account. It's nice. It's a really great way to set it and forget it. You don't have to think about paying your taxes and your insurance, and it doesn't feel like it stings as much, even though monetarily it's the same difference, right? You have the same amount of money come out of your accounts, but it just doesn't hurt as much when it's coming out on a monthly basis. But keep in mind, the taxes and the insurance are still your responsibility. So monitor those bills annually or every 6 months, depending on where you're at. When the tax bills come out, take a look, make note. Did your taxes go up? If your insurance has gone up, you want to make sure that you stay out in front of this so you don't just get that mortgage statement in the mail and have a big surprise. By monitoring your taxes and your insurance, you can then proactively reach out to the loan servicer as well, because they'll generally only run an escrow analysis once a year. I have a client who this happened to, a good friend of mine, where they had ran the escrow analysis, but the tax bills weren't out yet because they were late that year. And what had happened is the taxes did go up. They didn't think there was anything wrong, went through the whole next year, and when they ran the next escrow analysis, they had already dispersed 2 years worth of taxes to pay that shortage, and the amount he owed was off the charts. Definitely not something they were comfortable with. So be proactive, take that responsibility, watch your tax bills, watch your insurance, and you can make sure that this doesn't happen to you. Unexpected increases in our financial responsibilities are never a good thing. So the bottom line is be proactive and you can stay out in front of this. If you found this information useful, please remember, like and subscribe. It helps us keep this in front of you and other information, and it helps for the growth of our channel. So we'd really appreciate it. But otherwise, keep watching those tax bills. It's that time of year.